Hey everyone, and welcome back to Safe Simple Sound, College Planning Edition. I'm your host, Sam, and I'm really glad you're tuning in today. We know that navigating the world of personal finance can feel overwhelming, especially when big life events like paying for higher education come into play. Our goal here, as always, is to make complex financial topics feel safe, simple, and sound, empowering you to seize financial control. And today, we're tackling a big one. We're diving deep into a valuable tool that can significantly ease the financial burden of college, the American Opportunity Tax Credit, often known simply as the AOTC. Think of it like this. Paying for those first few years of college is a monumental task for many families, right? Well, the AOTC is designed specifically to help. What really stands out is, first, that this isn't just a deduction, it's a tax credit, meaning it directly reduces the tax you owe dollar for dollar up to a certain point. Second, the potential savings are significant. We're talking a maximum of $2,500 per eligible student per year. And third, a really powerful point, especially if your tax bill is low, is that part of this credit is refundable. That means you could potentially get money back even if you don't owe any income tax. This truly helps you understand your financial choices and leverage available benefits. So, how can you figure out if this college tax credit applies to you or your dependent student? That's exactly what we're going to break down today. By the end of this episode, our aim is for you to have a clear, actionable understanding of the American Opportunity Tax Credit and whether it's a benefit you can use to make college more affordable. It's all about giving you the knowledge to make sound financial decisions. All right, ready to unlock some potential college savings? Let's get started with our first topic, decoding the AOTC. The sticker shock for college education can be real, right? But here's the good news. There are tools out there designed to help ease that burden. Today, we're going to zero in on a really powerful one. We're decoding the AOTC, which stands for the American Opportunity Tax Credit. Think of this as a potential $2,500 college savings opportunity hiding in plain sight within the tax code. So what is the American Opportunity Tax Credit, or AOTC? Simply put, it's one of the key tax benefits for higher education offered by the IRS, specifically designed to make those initial college years more affordable. Now, the first thing to understand, and this is crucial, is the power of a tax credit. We often hear about deductions, which lower your taxable income. That's good, but a credit is often better. Why? Because a tax credit like the AOTC directly reduces your actual tax bill dollar for dollar. Think of it like this. A deduction is like getting a coupon off the price before tax is calculated, while a credit is like getting cash handed right back to you after the total is rung up, directly lowering what you owe. How does thinking about it as a direct reduction, a dollar for dollar slice off your tax bill, potentially change how you view the actual cost of tuition or fees? It makes that cost feel a bit less daunting, doesn't it? Okay, let's get into the numbers. How is this AOTC calculated? It's actually pretty straightforward. The credit covers 100% of the first $2,000 you spend on qualified education expenses for an eligible student, and then 25% of the next $2,000 you spend on those expenses. So let's do the quick math. 100% of $2,000 is $2,000, and 25% of the next $2,000 is $500. Add those together, $2,000 plus $500, and you get a maximum potential college tax credit of $2,500 per eligible student per year. This means if you or your family spent at least $4,000 on things like tuition, required fees, and essential course materials for a student, you could potentially qualify for that full $2,500 reduction on your taxes. Now, considering that $2,500 maximum credit, just take a moment to think. How impactful could that be for a family managing tuition payments, textbook costs, and all the other required expenses that pop up? For many families, $2,500 is a significant amount that could make a real difference, maybe covering the cost of books and supplies for the year, or taking a sizable chunk out of a semester's tuition bill. Another key feature of the AOTC is its specific focus. This credit is targeted primarily at the first 4 years of post-secondary education. Think freshman through senior year of an undergraduate degree program. It's not typically available for graduate studies or if a student has already completed 4 years of college level work before the tax year begins. It makes you wonder, doesn't it? Why do you think the government focuses this specific, valuable credit on those initial 4 years of higher education? Perhaps it's aimed at encouraging access and completion of that foundational undergraduate degree, tackling the cost barrier right when students are starting out. When you put all these pieces together, the direct tax reduction, the potential $2,500 value per student, and its accessibility during those crucial undergraduate years, it's clear why the American Opportunity Tax Credit is widely considered one of the most valuable education tax credits available to taxpayers. It's a significant financial tool designed to help students and their families invest in their future. So to recap, the AOTC is a direct college tax credit, not just a deduction. It can be worth up to $2,500 per student, calculated based on the first $4,000 in qualified education expenses. And it's specifically aimed at supporting students during their first 4 years of undergraduate study. Now, here's your call to action for this segment. Start thinking about the potential education expenses coming up in the next year for yourself or your dependent student. Consider things like tuition, mandatory fees, maybe those required textbooks or course software. And then picture that AOTC formula. 100% of the first $2,000, 25% of the next $2,000. How might that calculation apply to your situation? Just starting to map that out can be really empowering. In our last segment, we introduced the American Opportunity Tax Credit, or AOTC, and talked about its potential power, that amazing $2,500 maximum credit per student that can directly lower your tax bill. It's a fantastic tool for tackling those hefty college costs. But, like any valuable opportunity, especially one involving the IRS, there are rules. Knowing you might get a credit is one thing. Knowing if you and your student actually qualify is the crucial next step. So in this segment, we're diving deep into AOTC eligibility. Who gets to claim this college tax credit? And what hurdles does the student need to clear? Getting these details right is key to unlocking those savings. Okay, let's break down the AOTC requirements, starting with the taxpayer. That's likely you, the listener. First off, to claim the AOTC, you need to be the one paying qualified education expenses for an eligible student. Now, that eligible student can be yourself, your spouse if you're filing jointly, or, and this is very common, a dependent you claim on your tax return. This dependency rule is really important. Think about this. Maybe your child, who you claim as a dependent, worked a summer job and used some earnings for books. But if you, the parent, are paying the bulk of the costs like tuition and are claiming them as a dependent, you are the one who generally gets to claim the AOTC. It ties back to who is claiming the student on the tax return. It answers that question: who actually gets this valuable college tax credit when multiple people chip in? Usually, it's the person claiming the dependent student. Now, let's flip to the student side of the equation. Just paying the bills isn't enough. The student themselves has to meet several key criteria. First, they need to be enrolled at least half-time for at least one academic period during the tax year. This isn't just taking one class for fun. It requires a certain course load. Second, they must be pursuing a program that leads to a degree or another recognized educational credential. Think bachelor's degree, associate's degree, or certain certificates. Third, and this trips people up sometimes, the student must be in their first 4 years of post-secondary education at the beginning of the tax year. Essentially, they need to be an undergraduate. If they've already completed 4 years or have a bachelor's degree, the AOTC generally isn't available for them anymore. And finally, the student cannot have a felony drug conviction on their record as of the end of the tax year. Now, what are the common pitfalls here? That first 4 years rule and the half-time enrollment rule are big ones. Maybe a student takes a victory lap, a 5th year, to finish their undergrad. The AOTC likely isn't available for that 5th year. Or perhaps they drop below half-time status for the whole year. That could also disqualify them for the AOTC for that specific tax year. It requires paying attention to their academic status. Related to the first 4 years rule, but slightly different, is the limit on how many times the AOTC can be claimed for a specific student. You can only claim the American Opportunity Tax Credit for the same student for a maximum of 4 tax years. Ever. Think of it like this. Each eligible student gets 4 AOTC coupons to use during their first 4 years of higher education pursuit. Once those 4 years of claiming the credit are used up for that student, you can't claim it for them again, even if they technically meet the other student requirements. So careful tracking is important. All right, we've covered who can qualify. Let's quickly list some definite no's, situations where you cannot claim the AOTC. If your tax filing status is married, filing separately. This is a common restriction for many tax credits. If you, the person wanting to claim the credit, can be claimed as a dependent on someone else's tax return. This often impacts college students who might otherwise think they can claim it themselves, but their parents are actually claiming them. If your income is too high, there are AOTC Income Limits, specific thresholds for your modified adjusted gross income, or MAGI. We're going to dive into those exact numbers and what MAGI means in our next segment, but just know for now, high income can phase you out. And of course, if the student simply doesn't meet their eligibility criteria, we just discussed not enrolled half-time, past the first 4 years, etc. Finally, there's a crucial piece of administrative housekeeping. Both the taxpayer claiming the credit and the student must have a valid taxpayer identification number TIN by the tax return's due date, including extensions. For most of us, that means a Social Security number. This might seem obvious, but it's a hard requirement. You can't claim the credit without these valid numbers in place by the deadline. This ties into a question about documentation. What should you keep track of? Definitely proof of enrollment status showing at least half-time, maybe transcripts showing they are pursuing a degree and are within those first 4 years, copies of Form 1098-T, the tuition statement from the school, more on that later, and ensuring you have the correct and valid TINs for both yourself and your student well before tax time. Good records make claiming these things much less stressful. So, let's quickly recap the AOTC eligibility checklist. Taxpayer. Are you paying the expenses for yourself, spouse, or a claimed dependent? Student. Are they enrolled at least half-time, pursuing a degree credential in their first 4 undergrad years and without a felony drug conviction? Claim history. Has the AOTC been claimed for this student for 4 years already? Blockers. Are you married, filing separately, claimed as a dependent, or potentially over the income limits? Do both you and the student have valid TINs by the deadline? Phew. It seems like a lot, but breaking it down step by step makes it manageable. Your action item from this segment is straightforward, but essential. Review these specific AOTC eligibility criteria against your own situation and your student's status for the tax year you're considering. Really look at each point: the taxpayer rules, the student rules, the claim limits. Does your situation tick all the right boxes? In our last segment, we really dug into who qualifies for the potentially game-changing American Opportunity Tax Credit, looking at both the student and the taxpayer requirements. Hopefully, you have a clearer picture now of whether the AOTC might be on the table for you or your family. So, now that we've tackled the who, let's get into the what and how much. This is where the rubber meets the road financially. We're diving into AOTC financials, qualified expenses, credit limits, and refundability. We'll break down exactly what kind of college costs count, how your income plays a crucial role, and explore one of the most powerful features of this credit: getting money back even if you don't owe any tax. First up, qualified education expenses. This is a term you'll hear a lot, but what does it actually mean for the AOTC? We're talking primarily about 3 things. 1, tuition, that big number on the bill from the university. 2, mandatory fees, those required fees for enrollment or attendance. Think activity fees, technology fees, things everyone has to pay. 3, required course materials. This is key. It includes required books, supplies, and even equipment needed for a course. Think that expensive biology textbook, the specific software needed for an engineering class, or maybe art supplies for a required studio course. Now, a question we often get is, how can families accurately track these expenses, especially things like books and supplies that aren't on the main tuition bill? That's a great point. The tuition and fees are usually clear on the Form 1098T the school sends. But for those books and supplies, you absolutely need to keep your receipts. Whether it's from the campus bookstore or an online retailer, hold on to proof of purchase showing it was a required item for a course the student was enrolled in. Diligent record keeping here is essential to maximize your qualified education expenses AOTC. Equally important is knowing what doesn't qualify. The IRS is specific here. Common costs that are not qualified education expenses for the AOTC include room and board. Sorry, dorm costs or off-campus rent don't count. Transportation. Gas money, bus passes, flights to and from campus are out. Medical expenses. This often includes those mandatory student health fees. Unfortunately, those generally don't qualify for the AOTC. Think of it like this. The AOTC is designed to help with the direct costs of learning, not necessarily the costs of living while learning. Making that distinction is crucial. Okay, let's talk income. Why is understanding your MAGI, or Modified Adjusted Gross Income, so critical? Because the American Opportunity Tax Credit has income limits. For the 2024 tax year, if you're filing single, head of household, or as a qualifying surviving spouse, the credit starts to phase out if your MAGI is between $80,000 and $90,000. If you're married filing jointly, that phase-out range is $160,000 to $180,000. What does phase-out mean? It means the amount of credit you can claim gradually decreases within that range. And if your MAGI is $90,000 or more single or $180,000 or more joint, you unfortunately can't claim the AOTC at all for 2024. So knowing your estimated MAGI before tax time is vital. You don't want to count on a credit you might not be eligible for due to AOTC income limits. We'll touch on MAGI calculation later, but it's basically your adjusted gross income with certain deductions added back. Now, for arguably the most exciting part, refundability. This is what makes the AOTC such a powerful tool, especially for lower to middle income families. The American Opportunity Tax Credit is partially refundable. Up to 40% of the credit you qualify for, maxing out at $1,000 per student, that's 40% of the full $2,500 credit, can come back to you as a refund, even if you owe zero income tax. Think about that. If your tax liability is already $0, maybe due to other deductions or lower income, you could still receive a check from the government for up to $1,000 just for paying those qualified college expenses. This makes it a truly valuable refundable education credit, offering real financial assistance beyond just reducing tax owed. There is one little nuance here. For certain students under age 24, like those who don't support themselves or have significant investment income, there might be restrictions on claiming the refundable portion. It's a specific situation, often called the kiddie tax rules interacting. So if that might apply to your student dependent, it's worth looking into the details in IRS Publication 970. So take a moment here. Think about the expenses you've paid or anticipate paying. Are you keeping track of those textbook costs? Have you considered where your income might fall relative to those MAGI limits? Does that potential $1,000 refundable portion change how you view the benefit of this college tax credit? Let's quickly recap the key takeaways from this segment. 1. Qualified expenses for the AOTC are specific: tuition, mandatory fees, and required course materials. Keep those receipts. 2. Room, board, transportation, and medical fees generally don't count. Your MAGI matters. Check the 2024 income phase-out ranges: $80K to $90 single, $160K to $180K joint to see if you qualify for the full amount. 4. The refundable part is huge. Up to $1,000 back, even if you owe no tax, making it a fantastic refundable education credit. Now for your action step based on today's discussion. Take some time this week to estimate your modified adjusted gross income MAGI for the tax year you're planning for. And start gathering or making a plan to collect receipts and records for all potential qualified education expenses, tuition statements, fee breakdowns, and definitely those book and supply receipts. All right, folks, so we've just unpacked the numbers behind the American Opportunity Tax Credit, what qualified education expenses count, how much that college tax credit can actually be worth, up to $2,500, and the awesome potential of that refundable education credit portion, even touching on those MAGI income limits. Knowing what it is and how much you might get is huge, right? But the next big question is, how do you actually claim it? And just as importantly, what do you need to watch out for? That's exactly what we're tackling now: the forms, the potential pitfalls, and where to turn if you need a little extra guidance. So let's walk through getting that AOTC onto your tax return. First things first, claiming the American Opportunity Tax Credit isn't automatic. You have to specifically ask for it when you file your taxes. The main tool for this is IRS Form 8863, cleverly titled Education Credits. Think of this form as your official application for the AOTC and its cousin, the Lifetime Learning Credit, though we're focused on the AOTC today. You'll fill this out with the student's information, the school's details, and your expense figures. Once completed, Form 8863 gets attached directly to your main tax return, your Form 1040. So the 1040 is the main event, and the 8863 is the crucial supporting act that makes the AOTC happen. Now, to fill out Form 8863 accurately, you absolutely need a key piece of paper: Form 1098-T, the tuition statement. This document comes directly from the student's eligible educational institution, the college or university. Why is it so critical? Well, it usually shows how much was billed or paid for tuition and related expenses during the year, which helps substantiate your claim for qualified education expenses. And critically, Form 1098-T should also contain the school's Employer Identification Number, or EIN. You need this number to complete Form 8863. Think of it like trying to get a manufacturer's rebate. You need the product's serial number and proof of purchase, right? The EIN and the 1098-T serve a similar purpose for the IRS. So, here's a practical tip. What steps should you take proactively? Don't wait until April 14th to wonder where that form is. Encourage your student or check yourself to look in their online student portal starting in late January or early February. That's typically when schools make the Form 1098-T available. If you don't see it, contact the school's bursar or student accounts office. Download it, save it, print it. Just make sure you have it handy, along with those receipts for required books and supplies that might not be on the 1098-T, but still count as qualified education expenses. Okay, a little dose of caution here. While the AOTC is fantastic, claiming it incorrectly can lead to trouble. The IRS takes education credits seriously. If you claim the American Opportunity Tax Credit when you weren't actually eligible, maybe your income MAGI was too high, the student didn't meet the criteria, or you couldn't substantiate the expenses, you could face penalties. More than just owing back the credit plus interest, the IRS can actually ban you from claiming the AOTC for future years, potentially for 2 years, or even up to 10 years, if they determine the error was due to reckless or intentional disregard of the rules. It's like getting a red card in soccer. You're sidelined for a while. So, getting it right is important. This naturally leads to the question, when does it make sense to seek professional tax help? Well, if your situation feels complex, maybe your income is hovering right around those phase-out limits, you're unsure about student eligibility rules, or you're juggling multiple types of education funding, consulting a qualified tax professional can provide peace of mind and potentially save you from costly errors and those future bans. It's an investment in getting it right. Another area to be careful is coordinating the AOTC with other tax benefits for higher education, like tax-free withdrawals from a Coverdell Education Savings Account or a 529 plan, also known as a Qualified Tuition Program, or QTP. Here's the key rule. You generally can't double dip. You can't use tax-free 529 plan money to pay for, say, $4,000 of tuition, and then use that same $4,000 of tuition to claim the American Opportunity Tax Credit. So, how might a family strategically plan? This requires a bit of thought. Perhaps you use the AOTC first, claiming it based on the first $4,000 of tuition and required fees books. Then, you might use tax-free 529 funds to cover other costs like room and board, if your 529 plan allows for that, or any tuition and fees above that initial $4,000. The goal is to layer the benefits intelligently to maximize your overall savings, rather than having them cancel each other out. It's like using different coupons strategically at the grocery store. One for the cereal, another for the milk, maximizing savings across your whole cart. Feeling a little overwhelmed? Totally understandable. The good news is you don't have to navigate this alone. The IRS provides resources. The go-to guide is IRS Publication 970, Tax Benefits for Education. It's detailed, but it covers everything. The IRS website, irs.gov, also has a wealth of information, including interactive tools and FAQs. And as we mentioned, never hesitate to consult a qualified tax professional who understands the nuances of education tax credits. So to quickly recap this section, claiming the AOTC means filing Form 8863 with your 1040. You absolutely need Form 1098-T with the school's EIN. Be careful. Errors can lead to penalties and future bans. Strategically coordinate AOTC expenses with withdrawals from 529s or Coverdell's to avoid double dipping. And remember, help is available through irs.gov, Publication 970, and Tax Pros. Okay, here's your homework, listeners. Sometime this week, make it a point to 1. Locate your student's Form 1098-T for the relevant tax year. If you don't have it, figure out how to get it from the school. 2. Go to irs.gov and just pull up Form 8863. Glance through it, see what information it asks for. It makes it less intimidating come tax time. 3. Based on that, consider your situation. Do you feel confident navigating the AOTC rules? Or does reviewing Publication 970 or talking to a tax professional feel like the right next step for you? All right, everyone, that brings us to the end of our deep dive into the American Opportunity Tax Credit. Our goal today, as always on Safe, Simple, Sound, was to take this important, sometimes complex education tax credit and make it feel more safe, simple, and sound for you. We covered a lot of ground, from understanding what the AOTC is and how that potential $2,500 credit works, to the critical details of AOTC eligibility for both the taxpayer and the student. We looked at exactly what counts as qualified education expenses AOTC, discussed those crucial AOTC income limits, and highlighted how to actually claim the credit using Form 8863, making sure you have that essential Form 1098-T from the school. I think one of the most powerful takeaways is truly understanding the difference between a deduction and a credit, and how the AOTC directly reduces your tax bill. And of course, that fantastic refundable education credit component, the possibility of getting up to $1,000 back even if you owe no tax, that's a significant benefit that can really help families seize financial control when facing college tuition bills. Hopefully, this breakdown empowers you to understand your financial choices better when it comes to leveraging available tax benefits for higher education. Remember those calls to action. Review the eligibility criteria for your situation, start gathering those expense records, and locate your Form 1098-T. Thank you so much for tuning in and spending your time with us today. I truly appreciate you being part of the Safe, Simple, Sound community. For links to resources mentioned, including IRS forms and publications, please check out our show notes for this episode. If you found this guide to the American Opportunity Tax Credit helpful, please consider leaving us a review on your favorite podcast app or share it with a friend or family member who might be navigating these college expenses. And don't forget to subscribe so you won't miss our upcoming episodes. Until next time, stay informed, stay empowered, and keep making sound financial choices. This is Sam, signing off.